Everyone tells you buy real estate. It's the safest investment. Others say just put your money in index funds and forget about it. But nobody shows you the actual numbers. Today, we're doing the real math, real estate versus stocks. And by the end of this video, you'll know exactly which one builds more wealth over 20 years. Let's break it down. Let's say you have $50,000 to invest. You have two choices. Option 1, put a down payment on a rental property. Option 2, invest it all in the S&P 500 index fund. Both sound smart. Both have made people rich. But the math behind each one works very differently. And most people never actually run the numbers before choosing. Historically, the S&P 500 has returned about 7 to 10% per year on average, after inflation. That $50,000, left untouched for 20 years at an 8% average return, grows to roughly $233,000. No tenants, no repairs, no 2 a.m. phone calls about a broken water heater. You can sell part of it any time, and it costs you almost nothing to maintain, just a small fund fee, often under 0.1%. But here's the catch. Stocks are volatile. In 2008, the market dropped nearly 50%. In 2020, it dropped 30% in a single month. If you panic and sell during a crash, you lock in the loss. Stocks reward patience and punish fear. Now let's look at real estate. With that same $50,000 as a 20% down payment, you could buy a $250,000 rental property. That's the power of leverage. You're controlling a $250,000 asset with only $50,000 of your own money. If that property appreciates at just 3 to 4% a year, in 20 years, it could be worth around $500,000. Meanwhile, your tenants are paying down your mortgage for you. Add in rental income, and many investors also collect $500 to $1,000 a month in cash flow. But real estate has hidden costs: property tax, insurance, maintenance, vacancies, and property management can eat up 30 to 40% of your rental income. And unlike stocks, you can't sell one bedroom if you need quick cash. Real estate is powerful, but it's also work. It's a part-time job, not a set-it-and-forget-it investment. So which wins? Here's the honest answer. It depends on leverage and effort. Stocks give you better average returns with zero effort and full liquidity. Real estate gives you leverage, meaning your gains are calculated on the full property value, not just your down payment, plus tax benefits like depreciation that stocks simply don't offer. The smartest investors don't choose one. They use stocks to build liquid, hands-off wealth and real estate to build leveraged, tax-advantaged wealth, often at the same time. The truth is, the best investment isn't about which asset is better on paper. It's about which one matches your time, your risk tolerance, and your goals. If you want hands-off growth, stocks win. If you want leverage, tax breaks, and don't mind the work, real estate wins. If this broke down the math for you, hit subscribe. Because next week, we're calculating exactly how much you'd need in each asset to retire by 40.